Let's talk about this question number 4. Got a couple of issues in this one. We have another book to tax difference, which we'll be good at by the time we're done with these things. But the other thing that we're dealing with here is this likelihood of the asset being able to be realized. There's an issue with deferred tax assets in that if you don't make net income at some point, they have no value. They can only be used to avoid taxes in future periods if you pay them. But if you don't make money, then you don't pay them. This problem is going to change from this fact to another fact that's going to say it is not more likely than not. That sounds kind of weird, but it's not more likely than not that you're going to be able to realize this benefit, which means that you're expecting not to be able to get it. And what's our journal entry then? But as far as this one, we're going to do it the same way that we've been doing them. We look at the deferred tax asset account. That's our steps. We can either do taxes payable or deferred tax asset first. Okay, it tells us that the deferred tax asset account had a balance of $35 million. And I'm going to put that in. This is us saying where we are. And now we need to figure out where we need to be. And it says that at the end of year 2, this book-to-back tax difference is estimated to be $80 million, and it's no longer equal to $100 million. We're going to take that $80 million and we're going to multiply it by 25%, because that's our tax rate in this problem. That gives us 20. Which now tells us that we need to reduce this account by 15, and that's my adjustment. And now I can start doing my journal entry. My journal entry is going to be, I'm going to write out the tax expense, but I'm not going to fill it in, right? Because that's not what I do. And then I'm going to do the deferred tax asset. It's not debit side, it's credit side. And then the last thing is taxes payable. And taxes payable is simply going to be 200 million times 25%. And that gives us 50, which then makes tax expense equal to 65. So deferred tax asset or liability, solve for that. You can then solve for taxes payable, and then tax expense just comes about from knowing those two things. This change in fact, deferred tax asset is not expected to be realized in part 2. And what we're going to do here is we're going to create a valuation allowance. And the valuation allowance is simply going to offset this balance. And it's going to be an increase in tax expense. That's our journal entry. So what we would have is tax expense for 35 and allowance for 30. Subtracting from it, it's an impaired asset, right? So I think that takes care of us with that one. Let's go ahead to the next.